Hello, welcome to today's webinar, Successful Money Management for Young Adults. My name is Anthony Matteo. I am a certified financial planner and financial advisor here at SageVest Wealth Management. We thank you for joining us today, and we hope that you all take something beneficial from today's webinar.
Hello, everybody. Ryan Albritton. I'm also a certified financial planner and advisor here at SageVest Wealth Management. Look forward to going down this path with you, and hopefully, as Anthony said, you can take something away from this webinar that you find helpful long-term in your financial life.
All righty. Thank you very much, Ryan. With that, we'll get things started right away. So today we'll talk about a number of different topics. We'll kick off with some financial basics. We'll review a couple topics related to cash flow management. We'll touch on saving and investing, and then we'll also end today's presentation with some tips and background on insurance. Throughout today's webinar, we'll be accepting any questions that you have. So we'll point you towards the Q&A section at the bottom of your screen. We ask that if any questions come to mind, that you put the question in the Q&A box at any point throughout our webinar today. Ryan and I will be monitoring it, and we will try to answer any questions that are relevant throughout during the presentation. And then if there are any remaining questions, we'll answer them at the end. So once again, the Q&A section at the bottom is there for any questions. So our first slide here talks about why financial literacy matters. A lot of times the question comes up, does money buy you happiness? The fact of the matter is it doesn't. However, there are extensive studies, and we've seen from our experience that having healthy money habits does provide you all with a number of helpful characteristics, of which the studies say that you gain stronger self-confidence, you allow for greater life opportunities, there's more financial freedom long-term. When you understand your financial matters and have a higher level of financial literacy, there's less inherent stress to life. It also, there also seems to be that you are able to have healthier relationships with your loved ones. So today, what we really want to get into is a number of financial related topics. And, the main takeaway is that if you haven't, started building these habits yet, it's not too late to start. But we always think that the earlier you begin on this path, the better you are looking forward into the future. So numbers and statistics do talk. On this slide, we have 3 different studies that talk to the importance of financial literacy education. Number one, 73% of respondents to a survey chose finances was their top cause of life stress. Again, that speaks to, getting going on these, on learning financial literacy, on building good habits financially. The earlier, the better. It can stunt, excess stress in life. Number two, 66% of respondents to the survey were unable to answer 3 out of 5 basic everyday financial questions. So that's almost 2/3 of Americans have trouble answering, simple everyday financial questions. This again speaks to the importance of, creating these habits early, starting to learn, different financial tips and topics early. And hopefully that will lead you to more of a, sound and successful path forward.
If you don't mind, Anthony, if I could just jump in there too, just on that top number there, 73% of respondents' finances are top cause of life stress. For any of you that may be in a relationship or considering one, it's also the top cause of stress among couples. and can really drive a wedge in between people when that does, infiltrate into relationships. So it's, again, as Anthony has pointed out a number of times, the earlier you can build the basic building blocks, build good financial habits, the better off you're going to be.
Absolutely. That's a very good point, Ryan. And here, ticking into the last statistic here, 39% of Americans can afford a $1,000 emergency expense. So that's 39% can afford. So what does that mean? 2/3 of Americans can't afford an emergency expense. That's certainly an alarming figure, right? Emergencies pop up, and one of the first and most important financial steps is to ensure that you have an emergency fund. So funds set aside for unexpected expenses. And, according to the survey, almost 2/3 of America don't have those funds set aside. So we'll talk more about that and kind of putting you on the right path, to ensure that you have that emergency savings built up, as well as, discuss a number of other things later in the presentation.
So going over some of the basic building blocks, again, we kind of will point back to this multiple times throughout, but really comes back to building habits and habits that you can take with you and consistently implement in your financial life. Some of the areas of financial literacy education include money basics. So how does money work? How does it play a role in your life and society? Spending. So how are you spending? How are you budgeting? How are you dealing with real life expenses? We all have them, and we have to deal with them. Earnings. So the value of your earnings in return for the work that you put in. So really understanding and getting a grasp of how that is operational in your life. Savings, it's incredibly important that people save. As Anthony just pointed out there, almost 2/3 of people don't have $1,000 for a large one-time expense. That's incredibly scary, to be completely honest. Banking, so understanding how the banking system works, how your banking works. We say they're beyond Venmo. Venmo is obviously an incredibly popular tool. It's a great resource, but it's also important to understand the ins and outs of your finances, your personal finances. And then borrowing, so understanding potential dangers of debt, and really making sure that you understand that before getting into debt. In particular, we point out credit card debt there, but really any debt for that matter. So it's really looking beyond the here and now into how, this might impact me down the road. And if you do have to incur debt, how are you going to, pay it off, for instance? Really creating a plan and having an understanding of where you're going, in the future.
Yeah, that's all great, Ryan. Thank you very much. I would just touch on earning, the value of financial earnings in return for your work effort. A lot of times people really don't understand the true amount of money that they're receiving, right? So if you're getting paid a salary, a lot of times you think, oh, I'm getting paid my before tax salary, my before deduction salary, and say, oh, I make $100,000, and you expect that $100,000 to come into your bank account and be that final bottom line number. So it's important to recognize net income, and that you have to pay taxes on your income. There are other deductions for health insurance, for 401k contributions, etc. And really understanding kind of that bottom line number of what comes in the door is something that's very important for younger professionals, even into people's later years. Really just understanding what's coming through the door.
And again, coming back to the habits, setting goals. Goals are important in many aspects of life, and it's very important as far as your finances are concerned. So, you don't have to get too tedious, too nitty gritty, but it's important to just consider these things. Think about, okay, what do I need near term? What do I need, intermediate, middle term, and then what do you need long term? Some areas where you may consider short-term goals, that may be setting aside an emergency fund. An emergency fund is incredibly important. It comes back to being able to pay for that $1,000 expense that comes up along the way, as we mentioned earlier. The last thing you want is to have to incur debt for those, things that may come up in your life, and naturally they do. Intermediate goals, you may be looking to purchase a house. That's something that we look at, generally a 2 to 10 year type of goal. So again, setting up a plan for, okay, well, I'm going to set aside, $500 a month or whatever it may be, in order to get to that point where you can, put the down payment down if that's what you're shooting for in that time frame. And then longer term, making sure that, you're looking beyond just the here and now. It's easy when you're younger just to think, okay, I'm just kind of living for the day, day to day. But the earlier you start saving for retirement, the more likely you are to actually achieve, whatever your goal may be of retirement. And it's not to say that you have to sock away, 40% of your paycheck. It's just important to start somewhere, start doing it, and get into that routine of actually setting aside, money for the various goals based upon the timeline that they occur in your life.
All righty, we'll now shift a little bit here and get into some cash flow management. I'll kick us off right away. And first slide here talks about budgeting. So budgeting is a very critical part to your personal financial planning. I'll tick through really just some of the basics of budgeting. It's important to ensure that you're spending less than you make, right? So what comes in the door, you want to make sure what's going out the door is less than what's coming in the door. It's important to plan for non-recurring expenses. So again, talking about that emergency fund. If your car breaks down and you need to put money into the car, do you have funds set aside for an unexpected expense like that? It's important not to forget taxes. Once again, going back to what I had touched on a couple slides ago, you may think you're making either, whether it be $15 an hour or $100,000 gross salary. Don't forget taxes. You pay taxes on all of your earned income. So that top line number will get reduced by those taxes. Reward yourself. It's always important to reward yourself. Put your savings, again, then pay yourself first. Both of these kind of go in line. If you do have savings, it's important to capture it. If you see increases in your pay, well, one of the first things that you should do is pay yourself, right? You should increase savings before you increase expenses. And last bullet here is just talking about the importance of making budgeting a part of your routine, as well as automating what you can. I'll touch on a couple things here. We'll be the first ones to admit, right? A lot of times people aren't going to come out and say budgeting is their favorite thing to do. However, it's important to do it. Now, we're not here to tell you that you need to look at your, income and expenses every day, and you need to track every single expense that you have going out the door. However, I am here to tell you that it's important to at least get a grasp on what that looks like. The last thing you want to do is to be totally blind to it. So having some sort of a grasp, some sort of control over your budget really, really helps, going forward and looking forward. To touch quickly on the automation part of it, one of the biggest and most important tips that I always tell younger professionals and really, middle-aged to older professionals is the importance of automation. automate your savings, right? If you have a paycheck coming in and you know the amount of dollars that you are going to be able to put aside to savings on that paycheck, have that as a direct deposit into a separate account. This way it's automatically capturing these savings and doing the things that you want to do. And really can be helpful towards charting a good sound path forward.
Yeah, and I just want to jump in there, Anthony. I think that's critical, is automation. We've seen it, we've experienced it with clients, and the easier you make it for yourself, the more likely you are to do it and stick with it. So again, that kind of goes back to even, some of the goals we mentioned earlier, kind of mapping those things out. Well, okay, I need this much automatically to go towards this much to automatically go towards that. Make it easy on yourself so that it's not something that you're constantly having to think about. Because if it comes into, your checking account and it's just sitting there, human nature, more likely than not, you'll find something to spend it on. So make it easy.
Absolutely. All right, moving right along. Talk here a little bit about budgeting technology. So the main point here is that, budgeting and actually doing it is easier than it's ever been. There are a number of tools that are easy to access, easy to use, that are available to monitor, budget, and really help put you on a sound track. Whether it be a tool that is available through your online banking, whether it's your checking account, your saving account, your credit cards. There are a lot of tools available through those apps. There are also separate tools. For instance, mint.com is a commonly used application, budgeting application that I hear a lot of good things about. And really the main takeaway of all of this is that with the technology we have today, the apps and the websites and the different monitoring systems basically do it with the snap of the finger, right? They have codes built in, and they have links to your different accounts, and they track the transactions. A lot of times the tool will code the type of transaction, and it really does just make it easier for you. And again, it talks to kind of automating the process. But yeah, it is very important, and it's kind of right there at the touch of your finger. We highly speak highly of budgeting technology that's available in today's day.
Anthony, we do have a question that came in here. Do you personally utilize any programs, and how do you implement, the use of those programs in your personal life and your personal financial matters?
Thank you, Ryan. That's actually a very good question. And Ryan, I'm not sure about you, but I myself, I do use mint.com. I'm not going to sit here and tell you all that, I log into my mint.com and look at it every day and code different transactions and make sure, my budget's on point 365 days a year. However, I will say that I do use the tool. I tend to look at it once or twice a month, just to get kind of a high level grasp of, again, what's coming in the door, what's going out the door, and kind of get a sense of what my bottom line number is that I can put away towards savings. And again, I'll track it on a monthly basis to kind of understand the trends of what's happening in my financial life. And if I see 1 month's a high spending month, then okay, maybe I'll take a deeper dive into what the heck I spent my money on last month, and see if there needs to be any minor adjustments here going forward. So I do use mint.com, and it's been helpful for me. But again, there are a number of different technology tools out there. Some directly through your credit card apps, your banking apps, or like I said, mint.com or other separate tools like that. Very helpful. I do see the benefit of them, and but that was a very good question.
Yeah, and I just to continue with that, I do utilize a system as well. It's just through my online bank provider. I've certainly seen Mint. I've seen some of these other programs. Most of them are, or a lot of them are very similar. And like Anthony, I am not logging in every day. I probably do a little more often than once a month. But I have a pretty good, grasp on what my general ins and outs are. But I think it's important, to do so somewhat regularly. Like you said, don't have to do it every day, but I think Anthony mentioned a good point there. Well, if you're doing it at least, say once a month, and you have a pretty good grasp of what your inflows and outflows are, you can kind of identify if you have a really, expensive month, so to speak, and you can kind of identify, okay, well, what actually made that occur? Just for really your awareness, and so that you're aware of your finances, where your money's going. And that's going to, impact, I think, how you spend, where you spend, when you spend. So absolutely encourage the use of these tools. And as Anthony said, it's never been easier.
Absolutely.
So getting into credit cards and debt, this is something that, is a difficult area for a lot of people, both young and old. It's not uncommon to see credit card debt. I will just tell you, straightforward, starting from the beginning, do everything you can to stay out of it. People don't realize when they are getting into these things that it's not uncommon for interest rates to be 20+%, 24%, 25%. And when you have that kind of interest racking up on a credit card bill, it's hard to get out a lot of the time. And a lot of people will just pay the minimum, for instance. So you just have this interest just constantly building. But there are some benefits to credit cards as well. But going over pros and cons, a benefit is establishing credit history. So especially if you're younger, starting to establish some sort of credit history, which is going to be important, especially later in life. You go to, purchase a vehicle, you go to purchase a home. Having a good credit score is really critical. And we'll get into that here on the next slide, I believe. Credit cards, they offer some buyer protection. So if somebody was to, steal your identity, credit cards generally do offer some protection if they were to utilize it to make purchases, for instance, so that you're not responsible for actually paying for said purchases. But again, dangerous if not used wisely. Best practices, pay your balance in full every month. Never pay the minimum, as I mentioned, because then you just have interest just constantly racking up. So pay the full balance. Track your spending on an app. That goes back to what Anthony was just talking about, understanding what is actually, going out. Start with a low balance limit or a secured credit card. So that'll, get you used to utilizing a credit card, but you don't run the risk of potentially having, let's say, a, $5,000 balance limit, but, that your general cash inflows only allow for you to pay for a, maybe $500 balance each month. And then open discussions and tracking, considering dual review of credit tracking. So especially, if you're younger, you could set up some system where, let's say a parent or guardian or somebody has the ability to also view some of your spending habits. And I know that can be a little bit of a touchy situation, but especially for, teenagers, even, maybe college age people, that can be a good system to again, build good habits.
Yeah, absolutely. I mean, I would just echo, it's really important not to let your, balances grow and to pay off the credit cards, in full every month. If you don't, a lot of times we just see some, spiraling downwards, and those balances grow and it becomes a bad trend. So
Yeah.
definitely pay your balances in full. But again, there are some positives to credit cards, right? Establishing your credit history can help you down the road to buy a home, among other things. So yeah.
So this breaks down the FICO credit score. So that's what I was mentioning earlier, is that, you can build credit history through the use of a credit card, for instance. There are people that are absolutely against it for it. It runs the gamut, but, as long as you're paying it off in full each month, that's the critical aspect. But looking at your credit score, so these are generally how it breaks down. So your score, if you're above 740, is exceptional or very good credit. 700 to 740, good. 669, 699, okay. 580, 669 is poor. And then below that 579 is bad credit. And really what we want to impress upon you here is to make sure that you are reviewing your credit score. You can look it up for free. Go to annualcreditreport.com. They'll be able to provide it to you. There's basically 3 rating agencies, so your scores may vary slightly, but you get an average. And again, it's important to regularly review that. That's, one way that people sometimes find that somebody's opened an account in their name, things of that instance. And you can do that annually without impacting your actual credit score. So it doesn't impact you in a negative way. Reviewing, so looking for areas to improve. So, you can get the actual information on your credit report to see what's adding to, what's, taking away from your credit score. So you can look for areas to improve. Creating a plan of action, again, that kind of goes back to looking for the areas to improve, making sure that you're looking to boost that score as high as you can, because that's going to help you get, lower interest bearing credit. Let's say you get, are looking to get a mortgage down the road. The higher your credit score, the lower interest rate you're generally going to get. And most credit works in that manner. And then making sure to monitor and review. So periodically running this report, making sure that you're reviewing it. It's not something that you have to take an hour doing. It literally takes, you can do it in 10, 15 minutes. And again, annualcreditreport.com, you can accomplish that. So this comes back to, one of the bigger expenses in one's life, if not the biggest expense for most people, and it's housing. So some things to consider if you're looking at renting versus purchasing. One thing with mortgages is if you don't put 20% down, you may have PMI. And what that is mortgage insurance. So it's an additional cost to you to secure that mortgage if you don't put the 20% down each month. Again, if you can get to the 20% number, great. Sometimes you can get, to a lower number than 20% and still avoid PMI. But if you can't avoid PMI, generally a good idea, again, because it's just adding to your actual mortgage expense, essentially. If you do have a mortgage, you can get a tax deduction for the interest on that mortgage. If you're itemizing your deductions. In the early years of a loan, most of the payment goes towards interest, not principal. I don't want to scare anybody, but if you ever get bored, you have 5 minutes, look up an amortization table. It is a heavy load of interest, especially early on in the course of having a mortgage. And then don't overextend yourself. Make sure that whatever you are paying for, your monthly mortgage bill is a comfortable amount, that you're not literally, taking yourself to the penny each and every month with your outflows. Some considerations with renting versus purchasing. Renting, little or no maintenance, which is a considerable benefit to a lot of people. Moving flexibility, so you're not locked in for a long term generally. Cost is generally a little less, and it has to do with no maintenance, things of that nature. But you also have some downside. There's no tax benefit, so you don't get that tax deduction if you have a mortgage. And then you're not building equity. So you're not building anything that you could later, sell, for instance, for value. Purchasing pros, so building equity, so actually building value that you could potentially sell and make money off of down the road, potentially. All depends on the housing market, where prices go. A sense of community, so having neighbors, things of that nature, you could build a sense of community. Potential income if you were to rent a property. But again, you do have some downside with purchasing and as well. The cost. So you have that upfront cost. If you're getting a mortgage, having that down payment can be significant. Ongoing costs, maintenance on a home is it's significant in a lot of cases. Your water heater goes out. Well, there's an easy, $3,000 right there that you have to come up with. And when you are a homeowner, you generally find out pretty quickly that things do come up, and they come up regularly. And then market risk. So prices do fluctuate. So they go up, they go down. Especially if you're in a home for a shorter period of time, market risk can be significant and serious, because, well, what if the market drops 10%, 15%, 20%, and you then need to sell the home? So generally, you want to make sure it's more of a long-term commitment when really getting into a home. Purchasing versus leasing a vehicle. Won't spend too much time here, but just a couple of considerations, things to think about. Purchasing a vehicle, initial costs are often higher. Payments eventually in, so you eventually do end up owning the vehicle at the end of the loan term, if you do have a loan on your vehicle purchase. And you could sell it, or you could keep it. You have optionality there. Whereas with a lease, you're generally going to see tempting offers. They may really try to suck you in with these low monthly payments, but then who knows, you may have a significant upfront cost that you have to outlay. Ongoing payments, so you're going to have payments throughout the term of the lease. You generally have mileage limits. They vary, but they may only be, say, 10,000 miles. Well, what if you plan on driving that car more than 10,000 miles a year? Then in a lot of cases, you're going to be charged on each mile. So that can get quite expensive quickly. And then wear and tear. If you do, have extensive and excessive wear and tear on a vehicle when you do go to turn it in at the end of the lease, that may come as an additional cost to you as well. So again, it's not it's not too complicated here, but it's you want to take into account all these factors. And generally a vehicle purchase or a lease is one of the more expensive things a younger person is going to encounter, especially, let's say, when they get out of college or soon thereafter.
Yeah, absolutely. Ryan, thanks for all of that. I just touch on this, and even the purchasing versus renting. There's really no one size fits all, right? We talked through a lot of the pros and cons for each decision, but it's really a personal decision that you have to look at, kind of where you stand, what your finances look like, what your objectives are, and then make that educated best decision that best suits your needs.
Absolutely.
So again, just
well,
one size fits all. And
no, that's a good point, Anthony. And I just want to come back to that. It is important to consider your personal situation. It is really with finances in general, but speaking to vehicles in general, you have some people, and we've encountered this, that that, let's say they're serious car person, and they're going to be turning over cars every 2 to 3 years. Well, does it make sense for them to be purchasing and selling constantly? It may make more sense in that case to lease potentially. So taking into account those personal factors is critical.
Absolutely. We'll just touch here quickly on student loan considerations. So another large expense that we see amongst the younger generation is certainly student loans. It can be a hefty monthly payment that needs to fit into your budget and needs to be accounted for. It's really important to first kind of understand the total cost of your loans, right? You may think you have $20,000, but you have to recognize that there's interest on that $20,000 and how much those loans truly cost you in the end. I'll be the first, to admit here there are a number of different repayment options, and again, it goes back to kind of determining what best suits your objectives and your situation. But it's important to evaluate and understand the options that are available to you. A lot of times you'll just start off and say, okay, boom, I'm going to go with the 10-year standard repayment. You'll have a fixed payment for 10 years until you pay off all your loans. But it's important to consider maybe that's not the best option for you, right? There are income-based repayment models that takes a look at how much you're actually making, and then looks at a percentage of what you're making, and then considers how much you can actually put towards your student loan payments. It may take longer, and it will take longer to pay off those loans, but that may suit your situation better. Another consideration that we like to bring up is really a consideration before you even have these loans and before you even start repaying your loans. And it is really, to think about, are there ways that you can reduce your borrowing, right? Sometimes we'll see, students that have, sometimes they have funds set aside for college before they go, from family savings, 529s, etc. Then there's students that don't have money set aside, but there could be other ways that they can pay for this, right? Are there scholarships available? Is there student aid available? Can you pick up a part-time job while you're in school to help pay, help small amounts to pay your tuition, right? A lot of times any dollar helps, right? To kind of lessen the load at the back end for loans that you'll have to take out. So it's definitely important to look into your options, kind of, see if there are ways to reduce that amount you borrow, which generally will help you long term.
Well, and one thing that I've noticed and encountered, there's a lot of scholarships that go unused because, people just don't take the time to research, to do whatever the, qualification is. There's certain scholarships where you have to do nothing more than, write a paragraph. There's certain scholarships that could be because, your hair is a certain color or your eyes or whatever. I mean, it runs the gamut. There's a ton out there. So it really does pay to take the time up front, research, look for them, search for them on the web, and, apply for those that you think may be beneficial to you.
All right, so we'll switch gears here and talk a little bit about saving and investing. And you'll see a quote here. I'm just going to read it. Someone's sitting in the shade today because someone planted a tree a long time ago. That's a quote from the world-renowned investor Warren Buffett. And so we'll kick this off with a little more insight on the emergency fund. We've talked about it. We've kicked the topic around a little bit already in today's webinar. But the real crux of this is that you have dedicated savings set aside in a cash-like investment for 3 to 6 months of living expenses. I know Ryan mentioned, what happens if your water heater breaks. I mentioned what happens if you need work on your car, if you need new tires, if you need any other unexpected, emergency expense. It's important to first, in your financial kind of stepping stone, to ensure that you have these funds set aside to be able to pay for unexpected expenses. Here we'll talk a little bit about the different types of accounts. So, we get the question a lot, where do I save? What type of accounts do I save, right? There are many different options. I'll just tick through a few. We have the savings and checking accounts. So, right, it's important to have enough funds in both those accounts for your, monthly and near-term expenses, as well as an emergency fund. There's individual and joint brokerage accounts. So a lot of times you'll see people saving in what are called taxable accounts. Your individual brokerage accounts, your joint brokerage accounts. One of the key points here is that, if you do invest in these accounts and you buy stocks, bonds, mutual funds, ETFs, there will be capital gains taxes on sales that you make within the account. So it's something to consider, and I'm not going to get too into the weeds on that, but again, definitely keep that at top of mind if you're investing in those types of accounts. There's qualified plans, 401ks, 403bs. These are generally, provided through your employer as a added benefit at your work. It's certainly important to contribute to your 401k, to start early. Right. Ryan touched on the, 10+ year goal of saving for retirement. And a lot of times people just live for today and kind of kick that down the road. Any savings helps, especially early. So we'll talk a little more about that, in the slides to come, but starting early is important. One of the key things here is making sure that if you can, to contribute to your 401k to at least get the employer match. Right. I like to call the employer match free money, right? If you contribute 3% of your salary to a 401k, your employer will match 3%, right? It's different for different employers, but that's an example of it. So certainly look at what your employer match is and definitely at a minimum contribute in order to get that per se free money. There's then traditional IRAs, Roth IRAs. Those are other vehicles for savings. Both of these accounts have contribution limits. I'll touch quickly on the Roth IRA. It's very, very, very nice long-term tool. It allows for after-tax contributions, and the money grows tax deferred, so you don't pay taxes. You don't pay those capital gains taxes that I talked about on investments and trades that you make throughout the life of the account. And then when you are in retirement and you're over a certain age, you're able to take tax-free withdrawals. So it's really a potentially a very good long-term investment tool.
Anthony, we do have another question that just came in here. So if you were starting from scratch, how do you recommend prioritizing where to start? What of these various vehicles and these different types of accounts, for instance, if you're just completely new to it, just starting, where do you really prioritize?
Yeah, that's another great question. Again, I'll preface it by saying I don't think there's one size fits all. However, a lot of times the initial starting point is to make sure that you have that emergency fund, to make sure that you have the bulk of your, an amount of cash that's available in your savings and checkings for your current expenses, for your emergency fund. Once you get past that step, the answer gets a little more unclear. A lot of different schools of thoughts. I'm a big proponent of saving in different buckets, so that you don't just have all savings in your 401k, that you also have savings in your taxable brokerage account, a kind of a, I'm not going to say a 50-50 split, but certainly keeping both of those buckets plentiful if you can, and if your income and expenses allow for it. And then again, I'll circle back to the Roth IRA. Very, very positive tool. Great tax benefits, in the future. And you really, as long as for lower earners, right, there's an income limitation to when you can contribute to the Roth IRA. And once you get above a certain income level, you're no longer allowed to contribute. So when you're starting out in your career and you're under these income thresholds, or even later in your career, if you're still under these income thresholds, it could be a very beneficial tool to contribute to the Roth IRA.
Anthony, you mentioned 3 to 6 months in an emergency fund. You don't recommend stopping if you get to that 6-month mark.
Listen, no, I think again, it's kind of not one size fits all. if you get to your 6 months of emergency fund, no, I don't think you stop. I think you can, bolster that account. If you're able to, also if you're, hitting the other accounts, if you're contributing to your 401k, if you're putting some into a, brokerage account, if you still have funds,
Yeah.
certainly don't stop and say, okay, I have my emergency fund, let's spend the rest. Right. So it's certainly a balancing act. It's important to kind of dip your toes in a few different buckets.
Yeah.
And, but yeah.
Yeah, allows you to start having some of that optionality to save into some of those, quote unquote buckets, as you mentioned.
Absolutely.
So just touching on a few ways that you can invest your money, your funds. Just a couple popular ones that we'll touch on here. Mutual funds, for one, are a very popular tool. Basically is exactly what the words say there. It's a pool of funds, so mutual funds. Multiple people can invest it. They can be actively managed, meaning there is a fund manager that's actively managing those assets, or they can be passive and track an index. Let's say the S&P 500 or Dow Jones. Those are some of the bigger indexes that you may be familiar with. They give you the ability to get diversified investment exposure in, one fund, one area, and you have daily liquidity. So let's say you need funds, you can sell that at the end of the day, it's sold, and you can create liquidity there. Exchange traded funds, again, another very popular tool, and they've really become popular, the last several years. So they track an index or a basket of securities, and they trade on an exchange like a stock. So you can buy and sell throughout the day, whereas as with a mutual fund, it's just at the end of the day. Again, price changes throughout the day like a stock because it is being traded like a stock. One benefit to exchange traded funds is they're generally very low cost, which that can be a really important aspect of your investments, especially long term. The underlying cost of holding that investment being very low, it's eroding less of your actual, investment performance, your gains.
Absolutely. And Ryan, I'm just going to jump in. We actually have another timely question here.
Okay.
And I'm going to paraphrase slightly, but I'd ask you to kind of give us, the question is about crypto. I'm not surprised we got that question on today's webinar, but if you can just kind of provide a high level, your thoughts on cryptocurrency. I know that's potentially convoluted question, but if you can just quickly give us your high level thoughts to considerations relative to cryptocurrencies.
Yeah, no, absolutely. That's obviously become it seems like it's in the headlines almost every other day. So it's right at the forefront of people's attention, and especially I would say younger people. We have, as a firm, I'll say, steered clear of crypto. I still view it as very speculative, meaning, it's in the early days. We don't know where it's going. There's still a lot of, unknown surrounding it. Regulation is a big thing. A lot of cryptocurrency is used for, dark web activities, nefarious activities. So, in general, because of, some of those things, we have, steered clear. And I would just say that for those that are entertaining it, understand that it can have, significant risk, volatility. We've seen that over the course of 2022, for instance. A lot of people had built crypto as something that would be negatively correlated with stocks, for instance, meaning that they would move in different directions. So if stocks go down, crypto would go up. And it was the exact opposite throughout 2022. The stock market struggled and crypto got absolutely obliterated as well. So yeah, still, as I said, because of the speculative nature, some of the, you know, not so positive activity that underlies the uses of crypto, the lack of regulation, we just, again, steering clear for the time being.
Absolutely. I think I think that was a great overview of crypto. So keep moving along here.
So power of starting early. Anthony mentioned this earlier, just how important it is to start with something as early as you can. And this is just a nice little representation of somebody starting at 25 and investing for 10 years until 35, which, by the way, I would never recommend just investing from 25 to 35. But again, the chart is just to give you a sense of the power of starting early. So the top line you see there is Susan just investing, $5,000 a year between the ages of 25 and 35. So 10 years, $50,000 at 8% interest and retiring at age 65. So if she had just invested for those 10 years, $50,000 total, let it ride until she was 65 at 8% returns, she would have over $846,000. You can see the line below, the gray line, that's Mark. He invested from 35 to 45. So he delayed his start of investing 10 years. Again, $50,000. His total at the end of the day at 65 years of age is only $391,945. So less than half just by starting 10 years later. So again, shows the power of starting early, compound interest. It's highly important to start as early as you can. So risk tolerance, just touch on this quickly here. At the end of the day, when you start investing, it's important to consider your risk tolerance. Are you going to be able to sleep at night? You know, how long until you need the money? So if it's more of a short-term need, well, you may not want to put it into the stock market. You may want to consider something that's a little more, you know, risk averse. Understanding what you control, what you cannot control. Markets move on a daily basis. You have to understand that that's going to happen and you can't control that. And then being aware of analysis paralysis. That's a term we like to use that really is getting into the weeds to such an extent that you do nothing. So again, to make it really simple, I like to really just say, can you sleep at night? Are your investments bothering you, keeping you up? That's the last thing you want, but understanding that you know, those things do come into play. And the last thing you want to do is let's say be selling out of everything when you know markets are down just because you get a little bit spooked. But also want to consider your long-term needs.
Absolutely. Well, that's all great. And that was, you know, all for the saving and investing. We're gonna again shift gears here a little bit and talk about the importance of insurance. We're gonna, you know, tick through these slides relatively quickly here, but if any questions come up, feel free to let us know.
Yep, absolutely. So just touching on health insurance, just a couple of you know, highlights here. You can now stay on your parents' plan until age 26. So if you're on your parents' plan, something to consider, especially if you're in your early 20s just starting out, you know, it may be one less expense for you to deal with. Understanding deductibles, copays, out of pocket, in-network versus out-of-network. So really, again, just understanding what these things mean, deductibles being what you're going to pay before the insurance company starts to kick in. Copays, maybe a you know, set expense, $50, $100, it varies, that you pay when you go to see a provider. Out-of-pocket max, what is the total that you may be on the line for? What total out-of-pocket max may you have to pay in any given year? And then this is important, in-network versus out-of-network. In-network coverage is generally significantly less expensive. They negotiate rates a lot more, and you may end up paying a lot more if you go to an out-of-network provider. And then last but not least, health savings accounts are a tool that we love to utilize. They're available with some health plans, not others. It has to be a high deductible health plan, but they can be a fantastic way of getting tax deductible savings for health related matters put aside.
Absolutely. I would just touch quickly on the HSA's very, very cool tool, actually.
Yeah.
Tax deductible contributions, tax deferred throughout the life of the account. And then if you use them, if you use the funds for qualified medical expenses, they're tax-free upon withdrawal. So it's potentially triple tax benefit.
Yeah, it's the only thing out there that is. And one neat aspect as well is you can actually invest those funds.
Yeah.
So you can invest them like you invest any other investment account, with the potential of really growing those assets.
Absolutely. We'll touch here a little bit on our auto insurance. I'll just take us through the important considerations here. Number one, always never drive without insurance. That is the last thing you want to do. It's worse to drive without insurance than to have to pay a little extra than you want to pay for said insurance. It's important also to look for the best policy that you can afford. Make sure that you're getting insurance from a reputable insurer. All very important. As younger adults, when you are in your early 20s, especially males, your auto insurance is going to be expensive. Unfortunately, there's no way around it. So it's almost, you gotta bite the bullet in those early years, and eventually, as long as you continue good driving habits and other certain considerations, as you get older, hopefully your insurance costs will decrease. One quick item I want to talk about here is that there are minimums required by your state on the amount of insurance that you need in specific segments of the auto insurance policy. A lot of times those minimums aren't sufficient coverage for what you need. So, I would just recommend having an open dialogue with your insurer and discussing, what you need, how much you need, and making sure you're fully covered in the event that you were to need your auto insurance.
Yeah, that's a good point.
Renters insurance. So there are likely a few renters here on today's webinar. If you are a renter, it's important to have a renter's insurance. It's an affordable way to protect your property in the place that you are renting. There's also the possibility for including personal liability coverage. Someone's injured at the home that you're renting. And even going a step further, there's a possibility that the policy could provide you living expenses if you were displaced from the place that you were renting. Sometimes you can't even rent a home unless you have renter's insurance. A lot of times it's in the lease. You must have renter's insurance to rent this home. The good news is it's relatively cheap. It's relatively affordable. A lot of times you can bundle it with your auto insurance coverage and even get a discount. So don't fret if you need renter's insurance. Talk to your insurance agent. It's relatively cheap and it'll provide you important coverage if ever needed. Life insurance here. There are many different types of life insurance. Obviously, life insurance is really not the greatest thing to talk about, right? It involves your end of life, etc. But it's important to consider what you need. There are many different types of insurance out there: term, whole, universal, insurance products. A lot of times term policies do the job for clients, and that's basically you are covered for a stated period of years, 10, 15, 20, relatively more affordable than a whole life policy, which covers you throughout your life. One of the biggest questions we get is, how much insurance do I need? Again, that is not a one size fits all answer, and it really depends on a number of different things. We've broken it up into, someone who is married versus someone who is single, and some of the considerations that go into how much insurance you need, but there are a number of additional considerations to consider. I will say a lot of times through your employer, you'll be provided coverage. It's generally one times your salary. You can usually access extra insurance for a price through your employer, but it's certainly an option for those starting out in younger professionals. Eventually, once you have a family and you need, a greater level of insurance coverage, you may have to look at individual providers. And lastly, we'll touch here on wills and estate planning. So again, it's not the greatest topic to discuss, but it is important to discuss. We always recommend that at a bare minimum, anyone over the age of 18 has some level of documents in place, especially a power of attorney and a medical directive. As you get older, it's important to have a will to be able to express, what you want at the end of your life and where you want your assets to go, and how to handle different end of life situations. Another, topic we have here in basic documents is a list of assets and liabilities. Kind of just important to show the, persons who are dealing with the situation, kind of understand what you have and be able to best help, transitioning assets and different things like that. Main point here, we think it's important for anyone over the age of 18 to have some level of basic documents. You hope you never need them, but the worst case is that you need them and you don't have them, and it just makes things more difficult. But that is that. Ryan and I both appreciate all of you joining us today. It doesn't look like there are any other additional questions. It seems like the three or so that we touched on during today's webinar were the extent of it. I'll give it, a couple minutes here, or a couple seconds here as I talk to see if any others pop up. But again, we thank you for joining us today. We hope you were able to, gather some valuable information to hopefully start and continue a successful path forward. Ryan and I are both always available. We have our emails here on the slide deck. Feel free to reach out to us, shoot us an email, give us a call. The phone number's on the first slide, I believe. We're always happy to help. Once again, we thank you for joining us today. And feel free to reach out to us at any time.
Absolutely appreciate it. And as Anthony mentioned, certainly reach out. We're happy to chime in and help wherever we can.
Absolutely. Thank you guys. Have a good one.
Take care.